Hi everyone, good morning. Welcome back to the podcast. Happy Sunday. This is a follow-up on the video which I did with Shashwath yesterday on Be Rich last evening, where we spoke about the credit market and what's happening in the credit market. And I did say at the end of the video, I'm going to talk about something, then take Shashwath's opinion on it. I have not primed Shashwath. Usually we discuss these things before the video and we kind of get our
bearings on all.
Yeah, we dot our I's and cross our T's before we get onto this, so we don't look completely frazzled. But I thought for a change.
Frazzled is being generous.
Yeah. So for a change, Shashwath is very, very, very smart, and he's quite wise for his age. So I thought I laid something which I laid out to him, and then get his opinion on it and what he thinks, because it ties in very closely to what we were discussing yesterday. And as investors, what are they doing and what they're looking at? Specifically, I wanted to talk about Indian market, and a lot of foreign investors are looking at the Indian market because India is outpacing China now in terms of population growth, and we have the potential to become the third largest GDP by 2028. But we do have our own obstacles. That's like, as a foreign investor, they look at key data points such as car ownership, which is India is still very low compared to China. The number of investors in our public market, which I did a video with Kesav on, we stand at 3 crores and something like 13 crores. With a population of 144 crores. Though we have very heavy usage of smartphones in India, most of it is focused on free apps. Then India has got its own issues, because though we are one country, culturally we are very diverse. Languages are many, cultures are many, and even from within states, it's very diverse from north to south. And initially, when this excitement of India's population size looking from outside, a lot of investors wanted to get ahead of the curve. They came running into India and dumped a lot of money into our startups, being very optimistic at the projections which are shown to them. Because most of these projections were given by guys who studied in IIT, IIMs, who went to US and did some Harvard, some Yale, and they created a network and they sold to their network, India is like this, India is like that, the Byju's and the Oyo stories. Now you've seen their evaluations plummet. They're all shedding jobs like nobody's business, like a rabid dog losing its hair, or a street dog losing its hair. These guys are shedding hair and it's showing their skeletal remains underneath. Unicorns are numerous in India, there's no doubt about it. Largely, most of them have been very unprofitable, reporting major losses. And I've also met many poor souls in many of Anand's meetups, where young kids who believed in these startups and joined and are still employed in the startups, and they've not been paid for the last 6 months, 9 months. They've not received their salary and they're very worried. And I'm looking at them saying, what are you still working for? I don't understand why you're going to office when they've not paid you 6 months salary. Despite all this, there is another set of companies, startups in India, which are referred to often in India as the Camels. These are companies like Zerodha, Zoho, InfoEdge Focus, which focus on paying customers, attention to paying customers, and control cost. Their thinking is completely 180 degrees opposite to Byju's and Oyo. They rather be small to start with and make sure from day one they have customers who believe in their product and are willing to pay for their product, and grow slowly and keep control and cost and deliver a solution and a product which is good and let that grow organically, then trying to bulldoze themselves in the market. Zerodha, this discount brokeraging software a lot of people use. I'm sure some of you use it too. They charge a very small fee for opening a new account, emphasizing on user value. And these kind of tech camels are very capital efficient from investors' point of view. Without much external funding for Zerodha and Zoho, self-funding for several years, they prioritized cost-effective operations, unlike our unicorns, which overspend on marketing and perks. Like Swiggy, you see them giving away Swiggy at time. And all those discounts you see on Swiggy, most of it is just investor money thrown into the unicorn, which is just burning through. You've seen it in Dunzo also. They'll offer free deliveries, trying to compete with Swiggy. Even Swiggy, Instamart, some of the product pricing is because it's all paid by the investors. Meanwhile, Camels also invest in training and employ broader talent pool. Zerodha avoids advertising. If you notice, you don't see any much Zerodha sponsoring, Zerodha advertising. They use a open source software, keeping overheads low, offering affordable prices, and very price sensitive Indian consumers. Indian consumers are very, very price sensitive. Believe it or not, though we say Tata in India, Indians do not care about brands. Indians first and foremost is price. If the price is good, Indian consumers will be loyal to the brand. The loyalty to a brand in India is formed not because of service. It's first formed because of price sensitivity. Then the rest is questioned. So unicorns don't work in that kind of a platform or that kind of an idea, while camels do. So this approach is a departure from Silicon Valley's model, which has been this tried and tested method which they tried to do in India, which is to capture the market first, meaning like Amazon. Get inside, burn the forest, and level the field, and then build on top of it. Yeah. But that doesn't work. I'm saying that I'll worry about profits later. It worked for Amazon in the US because back then there's not many people doing it, and investors were patient to wait for Amazon to turn the corner. For a long time, Amazon was not profitable at all. If you guys see the history of Amazon, and that doesn't work in India, and that too is now done by everybody. It's like IPOs. Initially, Indian IPOs were very valuable because the launch price of the IPO was like 10 rupees. Now you can't imagine any IPO in India being launched at 10 rupees because all investors and owners want to carve the pie off immediately now. They want to first eat. Before even the investors get to eat, the promoters want to eat nowadays. So that is the same true with Byju's and Oyo, if you noticed. However, investors often push for rapid growth because of posing a challenge for companies to focus on steady profits, because investors are demanding rapid growth, rapid expansion. They want the brand to be in the foremost, in the front. Companies find it very hard to work on steady profits. So this atmosphere is changing in India due to funding winter, which ties into what Shashwath was talking about, the credit squeeze which is going on because of the rising interest rate. There's no free cash flow happening now. So money is not freely flowing from US to India, and there's lots of issues which are there. And because of that, people are now prioritizing on focusing on companies which are profitable first, who are cost efficient. And this is a different model from the unicorn model. And I thought Shashwath can shed some idea on, from his point of view in economics, why this is always tried and tested Warren Buffett method, Charlie Munger's method. And strangely enough, this will tie into today's evening video, which I'm going to tell Shashwath about once he finishes giving me his input on this.
Yeah. I mean, the answer is pretty simple. Way more simple than you'd expect it to be. Do you see more Ferraris out on the road, or do you see more Wagonars? Or do you see more Ferraris out on the road, or do you see more Kias? Or do you see more Ferraris out on the road, or Porsches, or Lambos? Or do you see, Innovas and, even Tata cars, Tata Nexon and these cars? Yes, both of them are extremely comfortable and extremely popular cars. But one of them is cheaper, reliable, and one which prioritizes efficiency. And yes, this is not to say that a Ferrari is a terrible car. It's a great car. And
we're Ferrari fans.
Yeah, I'm a big fan of Ferrari, and it's my dream car. But that being said, I would not trade the Tata Nexon, which my dad owns, for that Ferrari. Because speaking about reality, where we live in a sense of world where reality can be quite grueling and cruel to deal with. And yes, it's great that Silicon Valley has this ambitious model of capturing the market and then monetizing. It's one method of going about things, and this was the guard, for a while. But now it's become the old guard per se, and you have a new guard of startups who have iterated on what has happened before, learnt from the mistakes of predecessors, and come out swinging in a completely different way. One, you have the new guard of cricket players, or rather the new guard of startups who've learned from their predecessors who just flashed their bat and gotten out, like how a lot of cricketers these days play. And now you have a newer generation of cricketers seeing these cricketers make their mistake and seeing that flashing your bat and making sixes and fours is not the best way to have a steady, consistent run rate. This is not something which has been new. It's been iterating for generations and generations. If you go back to the South Sea bubble started exactly the same way, where projections on projections were made, and you talked about all these slaves. So the South Sea bubble was based on the slave trade, and they talked about all these slaves who could be captured and traded, and there were actually there was nothing like that. There was no sort of market where the South Sea company could have profited the way they projected, but they did. and they burnt a lot of money. It became a Ponzi scheme, and people started pouring in money to make sure that they don't lose money. So what do I mean by that? So suppose your stake in a company is worth 30 rupees, and if now your company is short of capital. If you don't provide that capital, your company is going to perform at losses, and it's not going to be able to continue burning and competing, and the value of the stake which you have in the company will come down to 15 or even 10 rupees from 30. However, if you deploy a cool 100 rupees into the company's capital account, then the company can continue competing, and you can still continue peddling this growth story which your company is talking about, and your stake can even be 30 rupees or 40 rupees in fact. So the more you burn, the more your valuation is. So this is something which we've seen in the zero interest rate environment, and we saw it once in the South Sea bubble because interest rates were relatively low back then. And there was a lot of financial trickery which was done then, and a lot of it illegally. And now again, a lot of it is in the gray area for what these startups have done. And I believe that as interest rates rise and credit becomes difficult to access, a lot of the trickery which our modern startups have engaged in will start coming to light. Like what Byju's is slowly going through a fall from grace, which Baiju Ravindran, or whatever his name is, he's had a huge fall from grace in the way he's embroiled in a bunch of allegations with how he's managed his company. This only comes when the music stops. So that being said, why do I think being a camel is better than being a unicorn? Yes, being a unicorn is great. You have endless potential. You have an entire market you can burn into and then try to monopolize on. However, one thing you have to note is it's great if there's one unicorn, but it's not good if you have two unicorns. Two unicorns do not survive if they're in the same pool, because both of your strategies is to burn the entire place down with the amount of money you have and somehow monopolize. But if both of you have endless funders behind you, backing you, if Swiggy is going against Zomato and it's going against Uber Eats and it's going against all these other, yes, Uber Eats is not operating in India anymore and it's been taken over. But my point being that when you have 2-3 giants fighting, then you basically have the consumer who benefits from discounted and cheap prices, but you do not see a company which is built to last. That's not something you see. However, a company which starts with zero capital cost, or a company which requires zero capital cost or very minimal capital cost and doesn't burn capital, generates free cash flow. Now, this is the kind of company we like. This is the kind of company Warren Buffett likes. And Warren Buffett has been known to buy companies which strictly generate free cash flow. If your company doesn't generate free cash flow, Warren Buffett doesn't even bat an eye at it. And you might say Warren Buffett bought Apple, but look at Apple's numbers. Apple is one of the tech companies, so-called tech companies, which is actually a cash cow in the amount of free cash flow Apple is able to generate year on year. A lot of the manufacturing costs for Apple is actually quite low, and they have economies of scale. And this Apple brand, which they've built over time, is a logo they can slap on any product and charge a huge markup premium over their manufacturing costs. So if you look at their profit margins, it's great. So they're able to generate a lot of free cash flow, iterate over their previous products at a low cost, be able to research enough to have great chips come out like the M1, M2, and now whatever new technology they're developing. So this is the kind of tech company you'd want to invest in. And speaking about the camels to unicorn debate, I mean, there's no sort of debate, because yes, when there's 0% interest rates, you'll see companies like Swiggy dominating zero there. But once you have interest rates sort of kick into your normal real interest rates, where we have positive real interest rates, then you'll start seeing a lot of companies whose business model is burning cash won't be performing as well as these other companies who aren't leveraged. So that's my 2 cents on the matter.
And I think it's wonderful what you said. So you can just, in a nutshell, it basically boils down to unicorns being fantasy and camels being reality. Camels do exist, yes. Unicorns don't. That kind of sums it all up.
And what we're in right now is a desert. We aren't in a utopian forest.
No.
So when you're in a desert,
you'd rather have a camel.
Exactly.
Anyway, I hope you found this video interesting, this podcast interesting. Do tune in for the evening one, because I'm going to pick Shashwath further on the same concept, take him down another path where we're going to talk about again the same concept in another area above investing, and see what his opinions are there about something similar and what does he think there. Thanks for watching it, and see you in the next one soon. Bye.